Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I love to get his insights on the markets every couple months. We have a lot going on right now with a potential Fed rate cut coming up. I want to get his opinion if that is bullish or bearish. He runs the TraderAid trading service and also macro advisor with Aisha Tariq. You see her on the business television channels almost every day on CNBC, Bloomberg News, and Fox Business. Her business partner is Markets and Mayhem. Thank you for joining me again.
Thanks for having me, Jason. It's a pleasure to be back.
You're welcome, Mayhem. And we're recording this interview on Friday, September 6th, 2024. The gold price is a little bit below 2,500. It was overdue for a correction after a big run up the last 9 or 10 months. The 10-year US Treasury yield, it got down to around 3.7% yesterday. But first, before we talk about some of these other asset markets, I want to get your thoughts on the Fed rate cuts that look like they're coming up, whether it's 25 basis points or 50 basis points. I don't know which one it's going to be, but the Fed has pretty much telegraphed that there's going to be rate cut, at least one rate cut coming up for the September meeting. In terms of financial history, are these rate cuts bullish or bearish for the S&P 500?
So it really depends on context, and it's a great question. If the economy goes into a recession, typically rate cuts end up being bearish. And I know that's kind of a loose connection. If the economy continues to grow, rate cuts end up being pretty bullish. But it makes sense in a way because if the Fed is responding to a slowing economy, the rate cuts can stimulate demand. If it's responding to an economy that's really seeing negative growth, then rate cuts aren't necessarily enough to sort of stem the bleed. But I think there's a more important, bigger context at play here. And the reason I mention that is we're in a very unique period. We don't typically see fiscal fight monetary, and yet we are in exactly that environment and have been for over 2 years. And what I mean is let's say, the big cycle fiscal spend that came online in the summer of 2022 with the Chips and Science Act and the Inflation Reduction Act was a overwhelmingly powerful fiscal impulse that more than offset the impact of monetary tightening. And it was so powerful, in fact, between that and the cessation of debt issuance and some of the funny business with which tenors there's larger issuances and on the longer end, smaller issuances, full well knowing the short end tends to be more liquidity neutral or positive, the long end tends to be more negative. All of that shifting around allowed the fiscal impulse to overwhelm tightening. And that is why the most aggressive tightening cycle that the Fed has done in maybe 40 years was well received for the most part, right? We had a choppy time in 2022. You might call it a bear market, but it was nothing like what you would have expected with the velocity of hiking and the absolute heights of both real interest rates and nominal rates that were reached, as well as the sheer magnitude of quantitative tightening. So I think that with that all in mind, with the fiscal impulse having overwhelmed the Fed, we're now at an inflection point. I like to think of it as like a relay race where now the fiscal side is trying to hand off the torch to the Fed. And the problem here is that as the fiscal impulse slows, and it is, we're seeing some of the slowdown in these various acts, a lot of the initial, investment has been completed. And I think that leads us to a period of time that's a little bit precarious because the monetary liquidity impulse is likely to be much more subdued, comparatively speaking. So if we think about all the liquidity that came into bank reserves from that enormous treasury issuance, from all of this spend by the government, and we have to contextualize it, right? Because we like to look at data points. So this was the largest percentage of GDP as deficit spend that's ever happened with unemployment as low as it is. So it was enormous. It was unprecedented. That fighting of the Fed left a lot of slack in its wake. So the question now with this handoff into September's presumed cut of about 25 bips is that as we get into that relay race torch handoff, it's more likely that the Fed, the runner that's coming in next, is going to run at a much slower speed, because there's not that same liquidity impulse from what I think is just going to be 2 cuts this year, one in September, and I think we get another one in December. I think they continue quantitative tightening for as long as they can. And even when they stop, I don't know they're going to go full throttle into QE unless something big breaks. And so my base case is that even though often is the case, historically speaking, that if the Fed's cutting into an environment that's not necessarily a recession, it tends to be equity market positive. I think we also have to contextualize this with a lot of that forward return that we might expect was already borrowed and pulled into the present by this enormous fiscal impulse that eased financial conditions so much that it offset all of the Fed's tightening. In fact, it eased them so much we went back to financial conditions from before the Fed even started tightening, that level of looseness. And so I wonder if the Fed's monetary policy, their cutting, will be a powerful enough liquidity impulse to do anything but simply buffer the slowing fiscal impulse. And if that is correct, if the monetary impulse is significantly less, think of the runner running slower at the Fed than the Treasury, then that suggests to me that this cutting cycle could actually be somewhat bearish for the broader markets because we have a confluence of factors globally suggesting the economy is slowing. There is now this labor market slowdown we can see in a variety of data points: Challenger, ADP, non-farm payrolls, household survey, JOLTS data, and all of that portends to a situation where earnings growth can really be impacted. The other side of it is the AI narrative is breaking down. I know we're going to get to that. I just wanted to say that that also colors in the context because a big part of the last 2 years of bull market haven't just been the fiscal impulse, but a lot of money going into these tech companies under the presumption that AI was going to be the next growth narrative. And that's also not necessarily playing out. So my concern, Jason, and I love the question because it gives me the opportunity to really come at this from a couple different angles from a macro perspective, is that I don't think monetary is going to overwhelm fiscal. So the fiscal slow and the monetary impulse to cut, I look at it as the slowing on the fiscal side is more important, just like the growing on the fiscal side was more important than the Fed over the prior 2-year period. And that leads me to believe that we're likely to see a slowing economy, a reduction in earnings growth, and eventually an earnings recession and possibly an economic recession next year, but more than likely a market that has to reprice risk with a more conservative valuation where multiples need to compress here because the risks are appreciating and the catalysts are diminishing here. And the Fed's not necessarily going to make up for that by just doing some rate cutting on the margins.
So the slowdown in spending from Washington, D.C., it's probably just taking a break because of the election. I mean, I expect regardless of who wins the White House election and the congressional elections, I mean, it sounds like these projects, I don't know if you've seen some of their proposals, Cold War 2.0 spending, the military industrial complex, think tanks, PhD economists, consulting companies here in Washington, D.C., like Deloitte and Accenture, and those guys are all coming out with research reports saying that between 2 trillion and 10 trillion needs to be spent more in defense spending to compete with China and Russia. They're talking if the home prices crash a 50-year mortgage. They've done student loan debt bailouts. I mean, I think spending will pick up after the elections. It just seems that this is a pause for, I don't know, 3 to 6 months until the election is over and done with, because that's all that, almost all that Washington, D.C., the D.C. metro area cares about right now.
Right. And I think that's a great point. And it's actually an area that we covered in some of the research that we recently covered in Macrovisor, which is this idea that if either party has a sweep, which is likely, right? Presidential elections, you get a lot of down ballot follow through. So whoever the candidate is that is victorious tends to at least get a narrow majority in the Senate and in the House. And assuming that's the case, the most likely scenario, then it is likely that whomever the next president is going to spend rather aggressively. And it's a matter of who wins and what they spend on, and also what their regulatory or deregulatory agenda might look like and how that impacts the economy as well. So I do believe you're right. It is a temporary cessation, but I also wonder, is that velocity of new spend going to have the same kind of stimulative effect? Or is it going to be more just kind of picking up some of the slack in an economy where we've seen more and more and more government spend, government job creation has been one of the leading factors in kind of propping up the economy. And we have that law of diminishing returns. I think it takes something like $8 of new debt to create $1 of new GDP. So that law of diminishing returns on government spend really starting to hit as well.
Yeah, I totally agree. And because of these distortions in the government spending, and the government is so bad at return on investment for their projects, whether that's ESG, student loan debt bailouts. I mean, the student loan debt bailouts, who's gotten them? It's made no sense. I mean, I've just heard anecdotal stories, crazy stories about people that just paid off a large chunk of their student loan debt, and then they get another thing in the mail that the rest of it was paid off. And then there's other people that should probably have gotten some type of bailout and they didn't get anything. So it just seems like they're picking and choosing winners and losers at this point. But that, unfortunately, that's what government works. benchmarks with the world reserve currency and debt-based fiat currencies. The real economy, though, Mayhem, the real economy in terms of like small businesses, these small caps, companies that would have been growth stocks in the past, it just seems like the real economy has been bifurcated for over 12 months with the earnings calls, the conference calls. So the companies that are actually doing well, is it like Amazon, Walmart, Costco, the large cap tech companies? Those ones seem to be doing pretty well. And a lot of the mainstream businesses, like the small businesses that were growing, like restaurants and retail, they seem to not be doing very well for the last 12 to 18 months on the earnings calls.
Exactly. And I think we have a K shaped recovery off the trough of 2022's summer. We've seen the federal government and their spending stimulate pockets of the economy, but it has not been a rising tide that lifts all boats. In fact, quite the opposite. And part of that is the lagged and variable effects of monetary policy. There have been some impacts of the Fed's tightening, primarily on that segment, on the lower income consumers, on small and medium sized businesses, all of whom are at the whims of revolving lines of credit that reset higher with interest rates. They've never really seen that same recovery because they're not asset heavy and they don't have the optionality of putting a lot of their debt into fixed rate outside of, say, a home or a car. And on the other side of it, if you're a large business like an Amazon or a Google, you were able to refinance your debt at the COVID lows, and now you're earning pretty sizable interest on your cash that's in excess of what you're paying on your debt. So a lot of them are earning net interest income, which is probably one of the first times ever we've seen something like that at such a scale. I think that K-shaped recovery extends to multiple different facets of the economy: small and medium-sized businesses versus large, the bottom 50% of consumers versus more asset-heavy top 20%, the federal government, on the one hand, doing quite well versus state and local governments having larger deficits and more difficult times in a lot of regions. And I think that's the fracture, and that's what we need to concern ourselves with because it appears to be spreading. We see more layoffs in professional services. We've seen with the Challenger data, for example, the worst 2 months of tech layoffs we've seen since 2022. But zooming out to the broader professional services sector, we've seen layoffs there also rising and job creation there falling. If we look at the Challenger data, for example, that came out, I want to say yesterday, we saw the lowest hiring trends across all industries since Challenger started tracking data in 2005. ADP's payroll data showed us similar. Small businesses are laying people off, particularly the 20 to 49 employee segment, mostly in manufacturing, information technology, and again, professional services. We also looked at that BLS data that came out, those downward revisions, and they continue to press upon us the idea that the labor market was never quite as tight as perhaps we were led to believe, but also more importantly, when you dig down into the data, a lot more job creation in government, healthcare, and private education than some of the more dynamic industries that would be part of growth in a real recovering economy. And then when we look at GDP, we've seen government spending indirectly and directly having a big impact, propping it up. Then finally, you zoom out at real retail spend. Nominal measures are helpful to understand earnings impacts because revenue and earnings are measured in nominal terms. But if you want to understand economic impacts, we have to look at real retail sales. And when we do so, the data set available on the St. Louis Fred website, we can see that real retail sales really peaked in 2022 and have been flat to down since then, suggesting that consumers are paying more to get the same or even less. So I think that all kind of provides a narrative that, yes, there are businesses and people that are doing well in this economy, but it's a shrinking cadre. And on the other hand, the bottom tier of that K-shaped recovery are struggling more. We see credit card delinquency rates, for example, the serious delinquencies, those with 90 days or more of balances that are past due, surging to levels we haven't seen since the great financial crisis, which suggests that consumers are under a greater amount of distress. And this is amid a time where credit card rates have only come down modestly recently, but were recently at all-time highs. So the interest burden that consumers that are dealing with this revolving line of credit that aren't asset heavy, that have to carry debt in order not to really do discretionary spending, but just to make ends meet, just to bridge the gap in the budget, in the difference between where costs have risen and the lack of wage growth, that's also growing as a stressor. And as all this is playing out, the labor market is softening. So I do think a number of risks are growing in the real economy, as you said.
Yeah, I agree that there's a lot of data points that the real economy is bifurcated. You talked about the aggregate data for stagflation and shrinkflation, and then the Bureau of Labor Statistics. So I think they just revised another 800,000 plus jobs that they
Yes.
claimed were created, and they just eliminated those too. But the consumer, for whether it's not just like Dollar General, it's not just Five Below, like the really bottom working class, low budget consumer that's barely making ends meet. I mean, it seems like the middle class consumer companies, all those casual sit dining restaurants, they're closing locations like crazy. Anecdotally, my favorite Mexican food restaurant here in Northern Virginia, that's a small chain out of Texas. They just told me that the company has $30 billion of debt and that they're debating restructuring or closing locations. So, I mean, it sounds like there's a lot of data points here that the consumer, whether it's not just the low end, the middle class one, and the high end consumer, is cutting back in a lot of different instances.
Yeah, I think that we're starting to see it creep up, right? It started with lower tier consumers, but now it's really the bottom 50%, which encompasses a lot of the middle class. And then you're also seeing that destruction of professional services industry jobs, white collar job growth deteriorating as well, which means even some of those in the upper income brackets are starting to see some pressure. As all this is playing out, you see volatility picking up in the markets, and you also start to see some folks getting more concerned about the economic outlook. That's coming out in various measures of consumer sentiment. And I think that that tells us confidence is being reduced. So purse strings are tightening. And, restaurants, let's be real, it's never been more expensive to eat out. Are we getting more for our money? Not really. So the choice starts to become, do we want to go out and pay like, $16 for a meal at the least at some of these decent restaurants, or do we want to make something at home for like 75% less of the cost that's probably better quality and more healthy? Because I think the convergence is concerns about cost and concerns about health. And one can reasonably argue that seldom is it that we find restaurants that provide us consistently healthy food at a fair cost. And consumers are more concerned about both now, health and cost.
For $16, I'm not sure you can get any meat now at a lot of the restaurants around where I live. That's not like Frankenfood. That's not like full GMO and lots of chemicals and preservatives. I mean, like even for like a grilled chicken sandwich or something like that, at a lot of places, you're running like $12, $14 now. And for a decent hamburger, I mean, there's a ton of Shake Shack locations opening up in this area. They're still expanding, and I think they're taking market share. They have higher quality product. We were talking about this with the kavas, the sweet greens, the Shake Shacks. I mean, you're paying a premium for higher quality meat, but it's not cheap. You're looking at, for a decent amount of meat, like $20 or more for a normal meal that 5 or 6 years ago was probably $12 or $13.
Yeah, the surge in prices is something that I do think is starting to discourage folks. And you kind of think about it. People were either locked down or at least discouraged from going out. A lot of people didn't have their social trends really normalize until maybe 2022, 2023. And so there's all this pent-up demand as well. I feel like that impulse is starting to wind down. And that's another part of this. So there's more struggle, but there's also this idea that, okay, we've kind of gotten it out of our system. It's time to go back to, a life that we can afford. And I am concerned about where this goes, because my own outlook of looking forward over the next 12 months suggests that there is more room for this to weaken. You look overseas, the Chinese economy is not recovering. There's actually further weakness in the real estate sector. Chinese banks have record short exposure to the dollar in an effort to prop up their currency. And any kind of major stimulus they do would not only imperil their banks, because the currency would, of course, drop, but it also isn't enough, right? They've tried this piecemeal stimulus strategy for years. It's led to really no functional improvement. It's just been dead money in the Chinese economy and markets for years now, despite one promise after another. And since China is, by and large, the largest consumer of all kinds of raw materials and energy resources and otherwise, that has a big effect. And I think that the other side of it is we see the Chinese consumer is checked out. This is the largest middle class in the world now. And they don't want to spend because most of their assets are tied up in real estate, and they have no clarity as to what that's going to look like over 5 or 10 years. And we know if we look at Japan and their deflationary real estate crisis that they suffered from, it took them about 3 decades to climb out of that hole. And I just don't see the Chinese economy climbing out much faster than that. It's probably going to take at least 10 years. And I don't think that people are necessarily looking at it that way, but that's a drag effect on the global economy, and particularly their largest trading partners.
Well, they had a lot of central planning with their infrastructure, so they overbuilt like airports and a lot of commercial real estate and a lot of residential real estate, those luxury condos, tons of other infrastructure projects, bridges to nowhere, trains to nowhere. There was a ton of that for the last 20 years, I want to say. What was interesting though, and hardly anyone's talked about this in the mainstream financial media, was that in April you had record cash withdrawals from the Chinese banking system after I think at least 40 regional banks had failed. So the Chinese people there, they were panicking, taking cash out of the bank accounts, and they were buying what? Gold, physical silver, not either jewelry or coins or bars, and then also like Bitcoin. So that's kind of a bank run there, and they were worried about a yuan devaluation. I don't know if it's fully happened yet, but there's still the potential for that for bailouts and money printing.
Yeah, absolutely. And I remember going back to what you're saying, and it really central planning. There's so many great examples of how it doesn't work and it ends up causing many more problems than it could ever hope to solve. But I always found it funny going back to, I think it was 2006, 2007, especially in some of these major metropolitan areas in China, they were building empty cities and then in some extreme cases, knocking them down to the foundation, leveling everything and building again simply to pad GDP, because at that point, construction was like a third of GDP.
That is Keynesian ditch digging for listeners out there. Read Austrian School Economics and talk about like the Keynesian broken window fallacy that Keynes wrote, that like if someone throws a rock into a glassmaker's window and breaks it, then that's good for the economy. It actually is bad for the economy. That's at like a scale never seen before. The Soviet Union didn't even do stuff like that. So the Chinese government did misallocate a lot of capital. It was a jobs program though, because I guess they don't want a lot of angry unemployed men out there marching in the streets.
Yes, there's two things that tend to cause massive social unrest in China. One is inflation, and two is very high rates of youth unemployment. And we can see that second category is becoming a greater concern here, as last year youth unemployment got so bad that they stopped measuring it. Now they're measuring it again, omitting all students from that measure, and it's still something like 17%, which is the stuff of social unrest. And we also know one of the reasons the lockdowns ended in 2022 wasn't because she wanted to end them. It was because people started pouring out in the streets and demanding that they end.
I think they also counted like live streamers now who aren't making any money. They counted those as partially employed. I saw some videos on like China Observer and China Insight's YouTube channel where there are people talking about this, that like they're counting like people doing streaming, like making no money, no income off of it as partially employed now or fully employed.
Well, so I guess, BLS and the Chinese government can trade notes around about how we measure employment data, because it seems like no one really has it right. We see constant downward revisions in our employment data sets here. They seem to be somewhat disingenuous on their surface. We just saw with today's print that they revised down July and June. And today's print was below what the market, had priced in. And of course, going back to 2010, August prints tend to be understated and revised higher. But I have this funny feeling this one, too, will be revised lower when we get September's data.
So I want to ask you about earnings for the next 9 to 12 months for the rest of the S&P 500 minus the Mag 7, the S&P 493. Do you think that they're still going to be able to beat the numbers? So they'll talk the numbers down from the Wall Street analysts for top and bottom line for revenue and earnings, and they'll produce beats, and that will prevent kind of stocks from crashing? Or do you think that they're not going to be able to get away with these games, like lowering the bar? Because it seems that that's been going on now for the last 6 to 12 months. There's been a lot of bar lowering, and in a lot of these companies that you'd think would miss, they've been able to beat earnings still.
It's a very interesting question. I think that's been a phenomenon we've seen throughout 2023 and into the first quarter of 2024. Then I think when we got to quarter two's earnings season, we saw the opposite, that things were so priced to perfection that even if you deliver really great earnings, you get sold down, like we saw with Broadcom and, to some extent with NVIDIA, although they'd argue margin compression and slowing revenue growth is an issue with them. Now, when we look at the inglorious 493, the expectation from analysts is that that's where the growth is going to come from in earnings and revenue, while the Magnificent Seven or the Fantastic Five or whatever we want to call the group now that's narrowing, that is where earnings are actually slowing and revenue is slowing. So there's supposed to be sort of like we talked about the torch handoff from the Treasury and that huge fiscal impulse to the Fed and the much smaller monetary impulse. There's supposed to be a handoff from these, 5 to 7 companies that make up something like a quarter to a third of the S&P to this 493 that are still a large amount, but there are a lot of industries where there's dead money. There's a lot of industries where there's been, regulation that sort of strangled them and really impeded their ability to grow earnings or attract investment. So I would say on the one hand, there is this rotation underneath the surface, you can see it. If you plot a ratio chart between RSP and SPY, if you look at value versus growth in the large caps, if you look at low volatility versus high beta, there is this rotation into more defensive positioning, into more value, into more equal weight. And I think that is in anticipation of both a more difficult economic environment, but also that sort of torch handoff between, maybe we'll call it the Fantastic Five and the Inglorious 493. And we'll just leave Tesla and Apple in the nether. But with that being said, it's a great question because unfortunately, if the economic outlook is one that we're going to see softening growth, and potentially for at least a quarter or two until we really figure out what the new fiscal agenda is and that impulse comes online, then I do think we could struggle for a bit, even with those Inglorious 493. The good news is they're not priced to perfection like the Mag 7 or the Fantastic 5. Their valuations are arguably more reasonable, especially in some of the material space and some of the energy space. But on the other side of it, we have to contextualize that these are very cyclical industries. And so if you do have a slowing economy, if you have China's demand for energy going offline, if you have a lot of the fiscal spend that was providing, a lot of growth in construction and otherwise coming offline or slowing, that's not necessarily good for those cyclicals. So I think that overall, it's safer to be in the Inglorious 493. Like today, I was saying to Trader Aid members that I think it's time to look at that trade in long RSP, short SPY, long SPLV, short SPHB. That's the low vol versus high beta, long large cap value, short large cap growth. I think those pair trades can continue to work. And I think it has everything to do with that rotation into where money managers think it's safer because their mandate forces them to stay in equities. They can't just raise cash and put it all under the bed and get out of the market. So it kind of depends on where do they see there being more safe haven. So I think those parts of the market can outperform, but it may be outperforming in the context of a market that's becoming more choppy, more volatile, and is correcting potentially over the next month and a half. Now, as we get into say November through March, and we get into better seasonality, both for markets, but also for the economy at large. And we also start to see the idea of who's won the election. What does the fiscal agenda look like? A lot of the uncertainties behind us. Wall Street hates uncertainty. So when you start to see where that takes shape and you see where the beneficiaries are, I do think there will be some good opportunities in these as the economy and the government spend driven economy, the pseudo economy starts to come back online. But I don't think it's going to be like the glory days we've seen over the last 2 years where it's just up, and away, because due to passive investment and due to a huge concentration of earnings and revenue growth in really just 5 companies, there's been an extraordinary concentration of these 5 companies at the index level in the S&P and the NASDAQ. And if there's going to be this handoff, it's going to look a lot more like sideways to downward price action for a while until the weightings really shift up and become something more equitable and more reflective of their roles and their earnings growth in the economy. I posted a chart today to try to illustrate this. It was a chart comparing net income growth and market cap growth. And it shows how with these top 5 companies in the S&P, market cap growth has far exceeded net income growth really over the last 5 or 6 years. And that's, to me, a sign of a pretty prolific bubble. We're pulling forward future returns into the present, into these very, very large companies. And that's creating systematic risks because you have passive funds buying them as the market cap weight increases, but you also have other investors buying them because there's simply been no other choice. Now, as the paradigm shifts, and the AI narrative becomes upended a bit, and some of that hope and optimism has to be reevaluated. The question is, what does that handoff look like with a third of the S&P in such a small set of companies to a much broader set of companies where the winners are probably going to be a much smaller weighting of the total S&P? And I think it looks like a market that is going to have much rougher sailing for some time as that handoff likely happens. I simply don't think that 5 companies can continue to make up that much of the market when the story and the actual fundamentals do not warrant the valuations they have.
Yeah, and if you want to talk about small cap companies, they're even worse than the S&P 493 outside of the Mag 7 there. So the small caps, I mean, you had a bear market rally, it was a short squeeze, but 25 basis point rate cut, 50 basis point rate cut is not going to help the debt problems, revolving credit facility issues, the lack of available capital for a lot of these small cap growth companies. Also, a lot of these small cap growth companies, they were trying to fill needs for a lot of different types of consumer at the different price points. And a lot of the consumers are tapped out. So their customers are tapped out. And then their balance sheets for a lot of these small caps, they can't really use any debt with the cost of capital right now with credit.
Exactly. It's something like 42% of the Russell 2000 doesn't make any money, and a marginal reduction of their interest spend, full well knowing that there's a markup over Fed funds, the prime rate that they're paying, and some markup over that dependent on their risk factors. So you cut by 25, you cut by 50, even cut by 100 bips. It doesn't fix the overlying structural problems of them essentially being zombie companies. And unfortunately for shareholders, what it also means is it's much more likely that they're going to do things like dilute shareholders because it costs them less money than issuing debt. And so I think that we have a situation where the small caps, unfortunately, and I know there's been a lot of sort of early cycle optimism in the space, but unfortunately, I think they're set for much more struggle. I unfortunately and I say unfortunately not because I have any stake in it, but because I see a lot of other people really optimistic about small caps. But I would check that optimism because I think the Russell 2000 is in for a tough time, really, no matter who wins the presidency and pretty much no matter what the Fed does. And the big takeaway that I have looking at the Russell 2000 is it's an index of really not great companies. The companies that do well graduate from the Russell, and we're just left with the crappy companies. And, there's just not a lot of reason to want to get involved. Now, I do think there's a pair trade in there, and it's the same factor. It's the idea of long value, short growth in the Russell, right? The pair trade between, I think it's IWO and then the value side of the Russell equation. And I think that that's where you can make some money because the value side of the Russell will outperform the growth side of the Russell. That's the value is IWN, the growth is IWO. So that's been a pair trade I favored and made some money on and off over the last couple of years. And I think it's time for that pair trade to come back on. But in terms of the growth side, I have to say, Jason, I have zero interest in it. These are companies that, the words that describe them don't belong in this interview.
Yeah, and I think what's going to happen, the small caps create the majority of the job growth, whether they're publicly traded or not. So like the Russell 2000, like you said, I think only about 30% of the companies are profitable. So the Russell 1000, I've heard, is a better measure of small cap companies. But there's a lot of companies that are not publicly traded, small businesses. They're the majority of the job creators here in the United States. So if they're not doing well because of debt, the Fed raising interest rates is disproportionately hurt Main Street and small businesses and these small caps, which were normally the job creators for a healthy economy. But I think this is going to benefit those larger companies in the S&P 500 that are outside the Mag 7, maybe even the Mag 7. They're going to have the opportunity to go and buy quality assets from those companies. Either the company will do share dilution, like you said, or they're going to have to sell out the company for pennies on the dollar. And then the larger companies are going to get to buy the assets and get growth that way.
Yeah, there is that sort of vulture phenomenon that could happen too, where companies are selling below book value or they simply have to liquidate for financial reasons, and where they have value in intellectual property or tangible property, you could see some of those being transferred upward in the economic spectrum. And this is unfortunately the exact opposite of what we really need. I mean, what we've typically had during a more healthy economic rotation is you have a recession. The risk takers that didn't quite make it, they fall out of step. And it's usually a combination of different participants like savvy entrepreneurs and upstarts and other folks that get involved and buy these assets for pennies on the dollar so they can start new enterprises. And so that they can, sort of reflect that passing off of, okay, these were folks that didn't manage their risk well. Here are some people that have different ideas about how to do similar things, and they get an opportunity. But in this case, it's sort of the opposite. A lot of the scrappy entrepreneurs don't have that same opportunity in this environment. In fact, it's been very hard for startups and early stage companies right now. But like you said, the large caps overall are doing much better because they have these fixed rate debt facilities and their debt maturity wall is going out into next year.
Well, I think the best example for this is the last 18 months in the oil and natural gas industry, over $230 billion worth of mergers and acquisitions. And it is by far the largest amount of deal making. So you're seeing the larger and medium sized ones just go up and buy up the small cap. So if the company had like a liquefied natural gas export facility and they were planning on using a lot of debt to build it, now that's no longer economic. So you're seeing the larger companies come in and buy the project in Louisiana or Texas because it already has the permits. I think the Saudis are even talking about investing in a liquefied natural gas export facility in Texas. So I think the oil and natural gas industry, it's in the short term, it's not being rewarded for this. In the long term, I think there's some savvy acquisitions happening.
Absolutely. And it was very interesting how a lot of the medium and larger companies had deleveraged considerably and cleaned up their balance sheets, unlike a lot of companies in other industries. And that really afforded them this opportunity to come in and scoop up a lot of these assets at pretty favorable prices. So I agree with you 100%. I do think we'll see some incredible opportunities in the energy space on the other side of this when we actually start to see global growth pick up again and we need more energy production. Because one thing we know is that energy discoveries have been extraordinarily low for some time. I think 2021 was the lowest amount of energy discoveries in many decades before it. And obviously, we need to turn things around the other way if we're going to have all these higher level consumers of energy coming online.
Well, you also have the Permian Basin is kind of sputtering out. Yes, the oil production is at record amounts. However, the majority, if you look at the well data, a lot of the well data is showing that the percentages are tilting dramatically towards excess natural gas production instead of oil production. And so if I've interviewed a lot of oil experts on my YouTube channel for years now, and pretty much all of them say that like the capital expenditure required to keep drilling these wells is going to produce more natural gas. It's basically a very expensive, high capital expenditure treadmill just to maintain production, and it's going to start to decline once we eliminate a lot of the tier one production into tier two acreage. The other side of this, Mayhem, is the demand side, and this is the surprise part. This integrates with Mag 7, big technology companies. They're all planning like these tens of billions of dollars per year capital expenditures to build these next generation data centers. I don't know how much construction has started on the next generation ones, but the existing data centers, aren't they already energy hogs?
They are, and we're seeing a variety of different estimates that portend to the idea that there's going to be this massive expansion of data center energy demand. I read something from Dominion where they're saying now the lead time to connect a data center in Northern Virginia, which is sort of like the apex of all data centers in the United States because of the convergence of intelligence and commercial interests and, all of the bandwidth interconnectivity there, that it's now 7 years. And the average before that was 4 years. So that's going to create some delays. And indeed, a lot of these new data centers are not being brought online, and certainly not in a timely manner. One of the highlights from the Microsoft call was when analysts started to really critique their Capex. Microsoft, I believe it was Satya Nadella, the CEO, responded by saying, look, when we bring these data centers online, it's in a series of stages. We acquire the land, then we build out the actual structure, then we start to do like the setup, the wiring, get the power connected, and then finally we buy the equipment and bring it online. And he says they do it in graduated phases because they're never certain when that demand that the data centers really needed is going to come online. And that affords them some flexibility that if it doesn't pan out, they haven't put so much money into that one investment, almost as if to say, we're not really sure how much demand is really going to come online. So we're kind of dipping our toes in the water, getting ready, but we're not necessarily fully committed.
Well, I think Amazon is fully committed to this, but like you said, I think Microsoft might not be as much, although they have said that by 2030, they're going to build that $100 billion 5 gigawatt data center with OpenAI systems. I think NVIDIA may also co-invest in the project. They have not started construction on it yet, though, but it's a very interesting point about like they're trying to delay things or walk things back with the Wall Street analysts. The Wall Street analysts, though, Mayhem, they're not used to hearing these big technology companies talk about massive capital expenditure like a commodities producer, like a copper miner or an oil and natural gas company, because they're used to like software as a service. Like, oh, Microsoft just updated a new version of Office. That's not a lot of capex, and oh, they could charge. They raise prices. They're used to that type of business model. They're not used to like a high capex type of thing where they have to build out this insanely expensive infrastructure and then keep maintaining and upgrading the infrastructure and all the capital costs.
Yeah, and it's really interesting. I think that's a great point. And what you mentioned about what you mentioned about Amazon, it's really interesting to me because if you look at what they did in a reaction to the e-commerce surge during COVID, they overbuilt their warehouses. They overbuilt their logistical capabilities. They had to scale back, they had to fire, they had to, reduce their leases with Prologis for the warehouses that they didn't own. So they got too excited. Is that happening again now with data centers? Maybe. It's actually quite possible. They are the largest cloud host in the world, but interestingly enough, because of Microsoft's other data-driven initiatives, Microsoft actually has far more data center capacity than Amazon. So maybe that's why they're a little less amped up to fuel a enormous growth cycle in the near term, but full well still saying, over the next 5 or 10 years, they are going to bring more and more capacity online. Speaking of OpenAI, I got an interesting data point from it was Goldman Sachs, and it came through one of the web traffic aggregators called SimilarWeb, and it showed the number of monthly visits to the ChatGPT website has dropped significantly over the last 2 months. And I think that gives us a sense that, on the other hand, this whole LLM dynamic isn't necessarily panning out. And I can say that with some degree of personal insight. I've been testing these things, both the commercial and open source offerings, for 2 years. And while they show promise, we do have to understand what they really are. These are just multiplication matrices with inferred relationships between numbers, words, phrases, and other data points that is largely scraped or even in some cases plagiarized from other sources. And the so-called AI, if we can even call it that, does not necessarily understand in any way what the data it is or what those relationships are any more than it understands what you're telling it or what it's spitting out. And the problem with that is that you have a lot of situations where you're interacting with these and they lose track of reality. They either make up data or they make simple mistakes or otherwise. Now, if we're relying on these for tasks in production, that doesn't work. There's not that margin for error. In fact, there was a situation, I believe it was with a Canadian airline, and they brought an LLM to be the chatbot in. And the chatbot was interacting with various customers, and one customer had a rather frenzied interaction with it and managed to trick the chatbot into essentially giving him some kind of arrangement that was very favorable. And the company didn't want to honor it. So he sued them, and the judge said, you have to uphold it. Your company representative, whether human or not, made this offer. And it brings up some of the concerns about liability, about hallucination, about the lack of understanding what the context is of what it's reading and then how it's responding to it. And I think that's a big problem that's very underappreciated in the space. Yes, large language models, they do have potential, but there's a big problem here. And let's go to this idea of it's this idea of basically what's called retrieval augmented generation, or RAG. And we've heard a lot about this over the last year. Retrieval augmented generation is the idea that LLMs are so prone to errors that they need to have another data source that's verifiable that they can reach into before providing a response. And this has been heralded as some kind of move forward, like, oh, we're going to address some of the problems that are inherent to LLMs by essentially making them rely on some kind of search engine. And I'm thinking to myself, okay, but weren't they supposed to kind of augment or replace search engines and not rely on some kind of proprietary search based on verifiable data? Isn't telling the world that an LLM is so unreliable it needs to have another data source a tacit admission that the technology is far from being ready? And indeed, we're starting to see enterprises really pull back on working on these projects with the same level of initiatives and the same thought that we're going to apply it to just every single component of our company wherever there's large amounts of data or customer interaction or otherwise. So I do think that calls into question some of that big tech capex, because at the end of the day, like you said, investors are not used to this. They don't necessarily want to see it. And remember, wasn't that long ago, there was this huge capex by Facebook, which even renamed itself Meta, into the metaverse to conjure up some pseudo reality that was just a reinvention of, honestly, just online multiplayer video gaming. Like the actual metaverse has
like
existed.
The Sims. They were trying to sell to Sims real estate or something.
And if you think about it, like you go to things like what is it, Second Life, and I was researching this because I was wondering where did they come up with this metaverse term? Turns out in Second Life, about 2 decades ago, the name of the virtual capital city was Metaverse City. So not even the name is original, the concept or any of that. And so the reason I say that is there's a lot of parallels to that in large language models. We've seen chatbots and AI in the past. This is a more recent iteration. It is more technologically sophisticated. It does have potential over the next 5 or 10 years, but we're being sold a bill of goods that suggests it's far further along in its progress than it realistically is. So the ROI is not translating here. It has become a show me story. The biggest beneficiaries are really the pick and shovel sellers like the Nvidias and to some degree the Microsofts out there and the Amazon selling their, reselling their cloud compute time for these GPU clouds. But the customer, the folks that are buying the cloud compute, the folks that are sometimes directly buying the GPUs or indirectly financing them because they're renting the cloud time, that's not translating for them. We're not seeing a lot of companies being able to take this large language model technology and scale it in a way where they can say, yes, discernibly, we're going to attribute higher levels of productivity and margin expansion to AI. And on the other side, NVIDIA's story is shifting. Their revenue growth is slowing considerably, and their margins are being compressed by manufacturing quality issues with Blackwell, as well as their idea of full vertical integration, trying to monopolize every component of the data center AI space that they can, where they already have 90% market share in GPUs.
So if I could summarize what Mayhem just spoke about for the last 5 or 7 minutes, there's immense problems with a lot of these artificial intelligence software. These things are highly inefficient. They are making progress, but it's not efficiently. I think I saw that they have to run 5 or 6 learning language model artificial intelligence programs sometimes to answer one ridiculously easy question that a human could answer quickly. So the models, they're calling it what, a hallucination or something like that. So that's very inefficient. Each one of those searches requires an insane amount of electricity usage. They have not fixed those bugs yet. The other issue, which is important for Wall Street analysts, they want to see artificial intelligence investment pay off to revenues and profits and cash flows and things like that. And then you have companies like Adobe saying we're using artificial intelligence for like our software, like our video editing software and stuff, but we can't charge our customers any more money, and we have to spend all this capital expenditure on the software. So yeah, it looks pretty good, and yes, it's improving things, but the customers don't want to pay any more money, don't want to pay a premium for all the investment we have to make for the software improvements.
Yes, and I would even add something else that was very interesting. I read this. I was from a marketing study, I believe, from a university. They said that now consumers are AI fatigued, and it has to do with all of the over-the-top promotion, hearing about it everywhere, including the Oral-B AI-powered toothbrush, which I think
What? They
yes,
have a
yes.
Bluetooth. There's a Bluetooth on my Oral-B electric toothbrush. I don't even use it.
Perfect. So now we could have AI Bluetooth connected toothbrushes that do who knows what.
Was it
But the
going to play
reality,
music while I brush my teeth?
right into our oral cavity, so it resonates in our ears directly. But it's crazy because these products have now turned off consumers. The latest research is showing that when consumers encounter a product that advertises itself as being AI, they're less and not more likely to buy it, which is probably not what Apple was hoping for when they built all this AI into their new iPhone.
Yep, exactly. But Apple is like has a bunch of cash, and they locked in their debt at a low rate, and they're earning what, net interest? They're an enormous
Yes.
amount of net interest because all that cash parked.
Yeah, I think they have more cash than the US Treasury on hand, but Apple is also sort of a miracle of financial engineering. There's been no company in human history that's bought back the volume of shares that they've bought back that has managed to make it appear that their financials are better than they really are in terms of, say, their PE ratio or the EPS translating per share, because every time they buy back shares, there's less shares on the float. So it makes those numbers look more favorable than they really are. But when you zoom out, Apple added over $1 trillion of market capitalization with flat sales, declining iPhone growth, and earnings that are slowing. So it's rather incredible Apple is almost the epitome of, this sort of speculative bubble, but also the sort of nonsensical, magical thinking that exists in financial markets. But even more offensive is a company like Tesla that's valued as some kind of AI growth technology extraordinary company with unlimited potential to bring about robots and self-driving and some kind of car-based cloud that's supposed to be a similar thing to AWS that makes no sense whatsoever. And they're trading at a valuation that's outright offensive because the growth doesn't exist. The forward potential is something they keep walking for. We've heard about robo-taxis since 2014. They're supposed to come out next week for the last 10 years. And so you see a lot of this unrealistic, magical bubble thinking as well. I do think we're reaching the tail end of that. And like you said, investors are becoming a bit less patient. Obviously, Tesla is a bit of a story of its own. It's a lot more retail participation. It's some of the most retail participation we've ever seen for a company of that size. So it exists in its own sort of microcosm, more as a sort of cult of personality stock. But when you look at Apple, there's a lot of magical thinking by analysts in the sense that there's this belief that Apple can go from being a phone company to a services company. And yes, it's going okay, but it's not making up for the slowing growth in iPhone. And I also would just cap that off by saying Apple is also the perennial indicator of being late to the party. When they get into a technology, it's usually time for others to get out of it. A great example being the Vision Pro. We were 2 years outside of the metaverse. There was no potential that any of this stuff was going to come out. And they come out with a $3,000 pair of goggles that's poor quality, doesn't have a very immersive user experience. There's enormous amounts of complaints. And I think they only sold several thousand units and maybe only 12 of them are still in use today. I might be joking a little bit about that last number, but that's sort of what we've seen there. And now they're getting into AI. And you've got to be a little concerned about what that means.
Yeah, I think the prices are too high for those virtual reality, augmented reality goggles right now. The average customer can't afford them. So they're just too high. It's not something that could be a mass product like an iPhone anymore. So it's the price point $3,000 or more for the average person. It's way too much, especially with high interest credit card debt or a high interest consumer loan from some type of credit company with the amount of consumers using buy now, pay later. In terms of like OpenAI, is it just are they just losing market share to like other artificial intelligence companies in your opinion? Or do you think like that's just an industry trend that people are overexhausted and don't even want to use like the search function or the query types anymore?
I think that's a really great question. I think it's a bit of column A and a bit of column B. There's a lot of compelling competitors out there. Claude AI is one that people have given a lot of positive feedback. You also have Meta's Llama, and it's available in all these Meta products like Facebook, but it's also available for people to download and run off their own computer at home. If you have a decent video card, you can run the 8 billion variable model of Llama 3 Run right off your computer. And often is the case, it produces results that are on par with OpenAI. And there's no subscription. There's no divulging of data to another company. It's all self-hosted, which sounds strange for a Meta product. You'd assume they just vacuum up all of your data and sell it off. But in this case, it's actually a model you self-host and there's no telemetry or anything like that because it's all driven by these platforms like Ollama and others, where it allows you to have a full AI model running on your computer. So I'd say on the one hand, I do think that interest is waning a bit because folks are saying, I'm not really getting the value out of this that I was hoping for. Like if you ask a really complex question, you're more likely to get an obtuse and misleading answer or just an answer that doesn't necessarily help you. And so that can be a bit of a waste of time. The novelty factor wears off a little bit. But on the other side of it, I think that people that still want to be engaged with these are looking towards other products because quite frankly, there are better alternatives out there to ChatGPT. ChatGPT isn't bad, but it's not the only game in town anymore like it was 2 years ago when it was really quite unique and there wasn't really a lot of competing services. So I'd say based on the aggregates of data that I'm looking at, there's slowing in LLM investment by businesses and consumers are getting a little more turned off by AI. But where there's still interest, they're diversifying that interest and trying, sort of the idea of maybe the grass is greener over here. Well, maybe it's greener over there and trying a lot of these different products as well. And then finally, I'll add to that ChatGPT's web traffic is also dropping to some degree, not accounting for nearly all of it, maybe 20, 30%, in that they've rolled out an app. So users aren't necessarily directly accessing the website. But remember, folks aren't using all of their AI interaction over their phone. There's a lot more happening on computers. So otherwise, it's, a lot less useful.
So I would definitely agree that I think the stock market valuations, pricing in like growth for artificial intelligence and revenue growth and profits from these things is way, way ahead of itself for a lot of these companies. And but on the other hand, I also do think that a lot of investment for the infrastructure component from the utility companies, the data center service companies, the big tech companies, they're going to keep making the investments into the data centers. The profits are just going to be slow. They're not going to be in the next year or two. They're probably going to be closer to late 2020s, like 2028, 2029, 2030, before we start to see these next generation data centers come online, a lot of them. So I think the market, the valuations just got way, way ahead of themselves because you have to make all the investments. They haven't even really started building most of these next generation data centers. I saw an interview on CNBC or Bloomberg with the CEO of one of these companies that constructs the data centers. And he said, I think they have a $20 billion backlog, something like that. And he said that like they're building as fast as they can, but they have so many that are under contract that are paid for that they haven't started building yet.
Yeah, and it starts to beg the question as to if this does slow down, what does that backlog look like? What are the terms and the contracts? Do customers have the opportunity to opt out and maybe pay some kind of fee? But I think it is really interesting how there's been this huge buildup of excitement. You see backlogs at NVIDIA for their Hopper chips and now for their Blackwell chips that are expected to start shipping out in the fourth quarter of this year. And I always like to look at these things and say, well, backlogs are great to see as a sign of really high demand. But my question is, how durable are they in the face of a changing economy and some changing attitudes towards AI? And I think that's a question we're going to want to look at in terms of these aggregates of data going into next year, where I suspect it will be a little more rough and tumble. I feel like a lot of companies are going to have to, in one way or another, divest or at least slow down their investment in the space because it's not necessarily translating to the bottom line. And one of the key themes I've been saying is, and it's funny because I literally called it a show me story. And I said that eventually, I said this in early 2023, I said eventually investors will become more skeptical and eventually AI will become a show me story. And Bloomberg ran almost the exact verbiage that AI is now becoming a show me story in light of the quarter two financials that were coming out from the Fantastic Five.
Yeah, they ripped me off too in 2019 with the phrase repo madness. They started talking about that nonstop on TV too with the repo crisis. So I'm not surprised that they ripped you off and didn't give you any credit. With the backlogs, though, I mean, there's other case studies where these backlogs, they don't prove to be enormously profitable. We saw this in the bear market with the shale oil boom and bust. Leading up to like 2013, 2014, 2015, 2016. I was an oil analyst for my day job back then. And so like Transocean and Seadrill and the Diamond Offshore, they're all marketing like all the backlog orders they had for deepwater offshore rigs and leasing. Well, as the shale boom was ramping up and those companies were, just basically producing oil and natural gas at whatever price, because they could raise capital like Silicon Valley unicorns. I mean, they flooded the market, oil prices crashed, and I think like Seadrill went bankrupt 3 times. They were restructured. And then Diamond Offshore sold out for pennies on the dollar, and Transocean was on the brink of bankruptcy for a number of years. So, I mean, like, just because they have a backlog doesn't guarantee any types of future profits.
Exactly. That's a very well articulated point, and that's what I was kind of going for in the way I was contextualizing it. That it's nice to see, it's encouraging, but it doesn't really mean anything until it translates to actual spend, actual build, actual business being done. And so I think there's a lot of excitement, there's a lot of anticipation, but I think we've pulled forward far too much future returns into the present. We've sold investors and customers as bill of goods that all these capabilities exist that are not ready yet. And this idea of retrieval augmented generative AI proves that. There's nothing that's more conclusive than the idea of companies having to take a step back rather than forward and tacitly admitting these models are so inaccurate that we have to have a more venerable source of data to pull from in order to ensure that they give us marginally accurate replies. That's a step back. It's a big step back. And I feel like, unfortunately, that is going to give a lot of people pause as they realize that in reality, what you're just getting is a chatbot that sits on top of a search engine, which isn't really a giant leap forward in productivity or technology. And what I really wonder is if all this mind share was put into more productive endeavors, where would we be now? Would we have some better innovation in cybersecurity to keep our core critical resources safe? Would we have some better innovation in energy efficiency or otherwise? It just boggles my mind that every time one of these sort of technology hype train starts, and look, there's a lot of potential here. Don't get me wrong. Eventually, it's going to change the world. It's just not tomorrow. It's not next week. It's not next month. It's more of a 5-10 year out story. And I'm going to say something also. I do a lot of institutional consulting. And back in 2017, I was hired by a growth investor firm that buys both, or it takes stakes in both private and public companies to analyze Mobileye. And the key idea for them, and they were very excited, and I understand, they were saying, oh, self-driving is coming out in like the next couple of years, and we want to get involved in it. We think it's going to be this big growth area. And I had to rain on their parade because I have to provide accurate analysis. It's not only part of my moral constitution, but I feel really bad telling a client something that I don't fully believe in. They didn't want to hear it, but I told them anyway. I said, self-driving, yes, in the long run, it may be possible, but it's more of a 5-10 year out story than a 1-2 year out story. And Mobileye, unfortunately, is likely to be one of the poster childs of not necessarily being able to execute and get it. Mobileye today, their shares hit new all-time lows. They had already been struggling because the technology is, well, it's nowhere near ready. And now Intel is talking about divesting. And sadly, I think this is sort of representative of what we might see later in LLMs. It's one thing after another, where we see these technology innovation trends that are so complex, the average person can't necessarily comprehend all the moving parts or where we are versus what's being advertised. And self-driving very much fits into that bucket. And that was one that was heavily advertised as being far more ready than it really was, at this point, 7 years ago. And we're seeing the same with LLMs now. And so I am at heart a technologist. I love technology. I think that it's brought humanity forward far more than a lot of the other innovations that we've seen. And we are in this sort of fourth industrial revolution period where there is a lot of technological upheaval and innovation that's happening. But my concern is that this particular area of innovation is something that is a much longer time horizon. And I'll say it this way as well. When you look at when you look at these large language models, when you look at how they're supposed to learn, they have no concept of what this data is, what it means, how it relates, how it's supposed to be interpreted. They have no idea what we're asking it. It's all inference. That's what they call it. They call it inference. The problem with this is we're fast tracking something and avoiding the real crux of the issue. And the real crux of the issue is that as humans, we haven't spent nearly enough time or money or really invested in the amount of resources necessary to understand the human brain, to understand consciousness, to understand communication, to understand how we make relationships between words and phrases and places and smells and, all the different parts of the human experience and how we put that together. What we're doing right now, for example, communicating. This is one of the most complex tasks that the human brain undergoes. And we think that we can just skirt all of that, create an algorithm with a bunch of inferred relationships and simulate it in a black box that no one even really understands how it works. I don't think so. I think in order to have true artificial intelligence, we need to understand, appreciate, and be able to replicate at scale human intelligence. And I know there's dissenters. I know there's folks that say, oh, we don't need to understand humans. Computers will come into all this on their own. I'm sorry, I'm skeptical. And again, I'm a technologist at heart. I love technology, but I also see the value in the most powerful computer that we really have. That's our own brain. And AI still can't replicate it. And I don't think it'll be able to until we understand it.
Well, the other major issue with all this experimentation going on with these learning language models that make up artificial intelligence, you're using, in many estimates here, 10 times the electricity per attempt. So it's very inefficient. Do you think that Warren Buffett has a good approach here? He thinks that the utility companies, electrical utility companies, are going to be one of the best ways, picks and shovels, to play this if it is successful over the next 10, 15 years.
So I think there are some companies that are well positioned. I think the less regulated companies are probably going to be the ones that are able to take advantage of it more. Aisha's been tracking that space. She had some recommendations there that I'd love to refer you to offline. But in terms of what I'm familiar with, I would look, even though it's a regulated one, Dominion seems to be probably the best placed one that I'm more familiar with because I've been looking at that company for years and they just have an enormous pipeline of demand. And it really, the funny thing is AI or not, Northern Virginia and the amount of demand for data centers there is only going to grow in time. And I do believe that utilities are one area to take advantage of it. But I would also go back to a graphic that Aisha sent me earlier and was also shared in her breakfast bites yesterday, which was showing the hardware stack for AI. It's actually not as much semiconductors as people would think. It's all the other components, right? It's the networking, it's the perimeter security, it's the fiber interchange, it's the actual flash memory and the storage and everything else that makes up the majority of the spend and investment. So I also think there's still opportunities in companies if they see larger markdowns, like your Arista Networks, your Palo Alto, your makers of fiber optics and otherwise, your networking companies, your security companies, all of that is likely to benefit from this as a secular trend over time. And again, AI or not, because even if the AI story doesn't manifest the way that's being priced in, we know that in aggregate, bandwidth and data intensity are only going to grow in time. You've got a lot of frontier and developing countries that are also coming online. They're building up their own infrastructure. But in the United States, the most data intensive country on earth, we're only going more and more in that direction. And it is ultimately a good thing. It's just about using that computational power, that innovation cycle, and the collective gray matter, all the brain share involved to try to get the best out of, the economy, to try to build actual innovation that can enhance the productivity and the quality of our economy over time. Maybe eventually AI will do that, but in general, technology will. And we're going to need more bandwidth, we're going to need more capacity for data, and we're going to need more compute to get there.
I haven't seen a lot of estimates on this globally. I've seen mostly US estimates for electricity demand for these next generation data centers. But if you're going to have China, India, the United Kingdom, Japan, European Union all start to upgrade their technology and integrate and build these next generation data centers, in addition to the existing data centers that are near either in major cities or metro areas for what Netflix and YouTube, which is what the majority of data centers, what they're used for internet broadband and latency right now. You have to keep those data centers and then you have to build the existing data centers. I mean, that's insane electricity usage. That's a lot of copper. That sounds like we don't have the materials and infrastructure required for these next generation technologies yet. It's going to take at least 10 years, maybe 15 years of capital expenditure and investments for the globe to have all these technologies going forward.
And by the time we get there, we're only going to need more. And that's sort of the beauty of the technology cycle. And that's why I can remain optimistic on some of the secular trends, right? I still think the best quality companies in the space that are sort of the brick and mortar of building all this out, they're still going to do well over time. None of that is changing. The question is just how fast does that come to fruition? Is the AI accelerator going to be the key to that growth, or is it just going to be technological innovation and progress over time? And I think no matter what plays out, there is a bright future ahead for this space. But, the AI narrative and where it is now has just borrowed a lot of those returns, pulled them into the present, and created a level of euphoria that I haven't seen in this market for a very long time. And so that's the part that concerns me because, quite frankly, coming at it from the perspective of being both a technologist and an investor gives me some unique insights. And I feel like from the technological perspective, we're not anywhere close to, the sort of bill of goods that's being sold. But then from the investment perspective, we're finally seeing folks saying, okay, when do we get paid for putting all this money out into this speculative endeavor? And is it ever going to pay us back? I think that that's the question that, a lot of investors are struggling with. And NVIDIA's earnings kind of added some more skepticism to that question, as the situation with SMCI has as well, where it turns out that maybe they're engaging in even more accounting shenanigans, but at the very least, their lunch is being eaten by the likes of Dell, who are willing to take that Bezosian philosophy of your margin is my opportunity and apply it to their AI hardware space and basically sell servers for no markup because they know they can make money on services. But more importantly, they're consuming the market share of a competitor.
I want to ask you about the macro conditions and the macro factors and how that affects different asset markets right now, because it seems that a lot of these other central banks are in a rate cutting cycle, but before the Federal Reserve has actually cut rates, we've seen what the European Central Bank, the Bank of England, other central banks start to cut rates. That adds liquidity. Seems like a lot of the capital flows have come into those U.S. technology stocks, the Nasdaq 100, the S&P 500 that are heavily market cap weighted. But also, you've seen from other countries, the data has shown this. A lot of foreign investors have bought those short-term U.S. Treasuries for the stronger dollar and the quote unquote risk free short term US Treasury yield. Do you think that that's going to continue, or do you think that the macro factors are going to change and that there's going to be a rotation into different companies or sectors or assets?
I think that we do see some rotation happening. I think, for one, with the Fed now getting into a cutting cycle, that is going to cause more central banks, particularly in developing markets, to start to cut, because we have to realize there's a lot of dollar denominated debt. So if they were cutting before the Fed, that could appreciably increase the servicing costs of that debt, and also could cause some problematic currency, issues, because they're basically having to pay more to service the same interest on the debt as their currency depreciates in comparison to the dollar. So you've seen a lot of those central banks in developing markets waiting for the Fed to say, okay, now you can start cutting gradually alongside us. I believe that liquidity impulse is coming online. I also believe that we'll see investor appetites for longer tenors, longer duration exposure increase, because in a cutting cycle, you don't necessarily need to just focus on bills. You can start marching up to through 5 year notes. And we've certainly seen that in anticipation of the Fed. I think the 2 year note's gotten a little ahead of itself now. So I wouldn't necessarily want to buy today, maybe after the meeting when we get the SEP and they probably walk back some of these egregiously aggressive expectations of the Fed's rate cutting cycle, which is now pricing in 216 bips of cuts by July of 2025, which seems very aggressive unless the bottom falls out of the economy. But in terms of how this all impacts flows, I think outside of fixed income, I do believe risk appetite is likely to become somewhat more conservative here. And the reason I think that is because we are in a slowing economy. We do have this cutting cycle coming online globally, and that's helpful to add liquidity support. But we have to remember that the fiscal impulse of the Treasury and the broader economic agenda of the Biden administration, that CHIPS and Science Act and Inflation Reduction Act, added trillions of liquidity into the global economy. And the question is, does this cutting cycle really offset that? Is it going to be enough to pick up some of the slack left in its wake? And I'm not so sure. I think we do have at least a quarter or two of more turbulent times ahead of us where it makes sense to rotate into more defensive assets. And we've already seen that. August favored defensive stocks. They outperformed across the board: utilities, consumer staples, healthcare, things like that. And we're seeing a continuation of that into this week, which was the worst week for the S&P 500 since March of 2023. So when investors are reviewing their statements and they're looking at what's happening with some of the riskier stocks that have very, very high valuations, I think that there's some profit taking still to be done in those sort of fantastic five companies: the NVIDIAs, Microsofts, Amazons, and Metas and Googles out there. I still think there is more profit taking, as well as in Apple and Tesla, to be done, because quite frankly, the growth narrative is being upended. There's more questions forming about whether this Capex is going to turn out differently than prior endeavors that didn't, with the metaverse in not too distant memory, and albeit a different misallocation of capital, it's still one that lingers in investors' minds. When do we get paid back? Do we get paid back at all? So I think that folks are shifting into more defensive parts of the market. And I think that rotation continues into defensive areas like utilities, which also have the catalyst of growing power usage, but are a relatively defensive allocation because they pay a dividend in an environment where that so-called risk-free rate of return, like you said, is diminishing. So in that environment, folks are going to go to dividend stocks too, which is one of the reasons I like SPHD. It's a low volatility, high dividend, large cap ETF, and it tends to go pretty well in a pair trade against SPY in a more defensive environment. When you see that rotation out of the more risky stocks and into the more defensive dividend stocks. So I'm in favor of dividend stocks. I'm in favor of value. I'm in favor of low volatility. And I'm in favor of some of these pair trades, including long equal weight and short SPY, because I think that's where the institutional rotations are going to go. And by setting them up as a pair trade, I'm not only benefiting from fading the area where money is likely to go out, but I'm also benefiting from being long the area where money is likely to come in. I think that looking broader, looking over the next 12-month period, it's going to really depend as to who gets elected in the United States and what their legislative agenda is. Assuming they have a majority in the legislature and they're able to effectuate an expansion of fiscal spend, then it's going to be all about their priorities. If Trump gets elected and he deregulates in energy and materials and other resource areas, I think those areas are set to outperform. The sort of old economy stocks can really catch fire. I think if Harris is elected, it's going to be a different paradigm. One of the things she said is $25,000 stimulus for homeowners buying their first home. And I don't think that's necessarily a great idea. It's only going to increase the cost of living and house inflation, but it'll be great for home builders. And so there will be beneficiaries, as well as all the things you put in a home. All the companies that make the durables that we add into our home could benefit from that scenario as well. So for that period of time from sort of November on, we're going to have a lot more clarity about what that agenda might look like, where those money flows are going to come into. So I'll have a much better answer for you based on who's elected, but I think it's very contextual because the government is now playing a much larger role, much to the detriment of everyone and everything, in choosing who wins and who loses and which industries are the key beneficiaries. And as a result, we actually have to look more and more towards bureaucrats in the White House, in the legislature, and in the central bank to get a sense as to where the market and economy is going to go. Speaking of central planning.
Yeah, both parties are going to spend. So there's going to be a lull here before the election. Everything is shut down here in the DC metro area. Basically, it's all focused on the election and that. And then a couple of months after the election, the new policies, whoever's in power is going to come out with their new policies and their spending programs. And then where the funds go, that could be a temporary boom and bust or an ESG bubble, something like that. I mean, the return on investment, though, it's probably not going to help the real economy. It's going to help a lot of the corrupt insiders here in the Washington, D.C. metro area via the Cantillon effect.
I think so, too. I think we're in for a bit of a slowdown. And if one party gets the majority, they're likely to re-engage that fiscal impulse, and where it goes will be determined by their legislative agenda. And unfortunately, they get to pick the winners and losers. So, choppy bit of time up ahead for maybe the next 2 or 3 quarters. But then on the other side of that, I think we will have an opportunity to invest in a more dynamic environment, albeit one where maybe some of the strings are being pulled by bureaucrats in DC. But at the end of the day, as investors, we're just looking to put capital where it will be treated well. We have to divest ourselves from our emotion and focus on the rotation.
2 more questions before I let you go. So do you think the Fed keeping interest rates relatively high before the rate cuts, on a relative basis, the dollar was relatively stronger than a lot of other currencies, especially against the Japanese yen, the Korean won, other Asian currencies, and the Canadian dollar and stuff like that? Do you think that the Fed has started to break foreign banks, so Japanese banks, Chinese banks, Canadian banks, European banks? Do you think a lot of banks outside the United States are dealing with like losses on older treasury bonds, U.S. commercial real estate losses, dollar-denominated debt defaulting? Do you think that that's a real problem globally?
I think that it is a destabilizing force, and it's one of the reasons that there's this impetus to start the cutting cycle anew. Because it's not as if interest rates are unacceptably high. We're actually at rates that are closer to normal levels of interest rates, particularly if we omit the post-financial crisis level of ZIRP that we've experienced for, what was it, about, 15 years. I think if we kind of zoom out to a longer term of either central bank set rates or market set rates, the rates that we're at now are not unusual. They're actually healthy. But when you look at a global economy that has as much exposure to these various areas of debt that were largely bought at much higher prices, and now those debts are either left to mature, where they mature in many cases for 100 cents on the dollar, if it's treasuries or, government backed mortgages or otherwise, but on the other side of it, if there's any stress, they're looking at significant markdowns. It remains a problem. I mean, we look at the FDIC data for U.S. banks, you see there's still an enormous amount of unrealized losses on their fixed income securities. And that's not a problem that's contained to the United States. That is a problem that is all around the world. I mean, remember, there was a time where I think it was Austria was selling 100-year bonds for like a fraction of a percent. There's a lot of that kind of stuff sort of underneath.
China just sold it too. A 50-year or 100-year bond, China just sold it for ultra low rates too.
Yeah, so that's not good because that sort of debt, first of all, I'm old fashioned. So when I look at an interest rate, I'm looking at, am I being paid for the default risk with padding for profit? And if I'm taking 100 years of risk, there's no way I can calculate that. And if I can, it's certainly not going to be at a sub 1% interest rate. So I think there is a lot of distortions that happen due to the time scale of zero and negative interest rate policy globally that we can't necessarily separate ourselves from. There are a lot of distressed assets. And unfortunately, that's one of the reasons that we're being pulled back into this cutting cycle. It's not necessarily by desire, but by demand to reduce the probability of some kind of disorderly outcome. And I'll shift our attention over to Japan for a moment. When the Bank of Japan hiked interest rates, they set off a series of disorderly deleveraging situations from the Japanese banks because they were leveraged up to their eyeballs. They had, zero interest rate policy, and before that, negative interest rate policy. No one really expected that marginal increase in the cost of servicing debt. And when it happened, there was disorderly deleveraging. And it spread around the world. It started with the Japanese trading houses and it spread to markets around the world. And it created a lot of angst. And it was so problematic that the Bank of Japan's, one of their governors came out, wasn't Ueda, but was another governor, basically came out and said, if we are planning to tighten, but the market is volatile, we won't tighten. Basically telling the world, and this is the first time I've ever seen a central bank this forthright, that all you need to do is throw a tightening tantrum and we won't tighten. And that was ultimately what alleviated the pressure and helped to bring about this V-shaped recovery of re-leveraging and also a massive amount of put premium being destroyed, which is liquidity positive. Since during that episode of volatility, everyone was buying fire insurance while the building was on fire, paying huge premiums and ultimately having those puts expire worthless. So I think that we have already seen it play out, that higher interest rates can create this pressure to deleverage. And I think that if we kept rates at the levels they are, even at present, which by any reasonable measure aren't that high until you realize where we were over the last 13 years prior, that yes, there is additional pressure that can come online in dollar denominated debt, in treasuries, in mortgage-backed securities, and elsewhere if we don't get back into a cutting cycle. But I also think that there's this sort of desire to sort of sweep this under the rug. So I don't think we're going to see central banks cut too aggressively unless and until something breaks. So I'm not in the camp of 216 bips of cuts from the Fed or 100 bips this year or even 50 bips next meeting. I'm much more in the camp that the Fed is going to go steady as she goes because more than half of their job is managing expectations. We know that there's lagged and variable delays in the policy outcomes. And so they want to bring forward those policy outcomes any way they can. And the best way to do that is manage expectations. So if they came out in September and said, hey, we got it all wrong, we're going to cut by 50, it's actually going to unleash more uncertainty and more angst and more volatility than salving any of the wounds that may exist underneath the surface on some of these balance sheets. But on the other side of it, when push comes to shove, we know all these central banks will cut aggressively and even add their own forms of QE if the bottom falls out. So I think we're in a holding pattern. I think the Fed is going to continue to look at the labor market, which we know is all lagging data, and it's probably worse than what we're seeing, but they're going to make a lot of their decisions based off of that. And I don't think they're going to go too hard into this. I think one area of opportunity here, and it was even an opportunity I identified in a live stream today and played out in near time, is that every time SOFR is mispricing the resolve of the Fed, it's an opportunity to fade it. Today, when the probability of a 50 bips cut in the September 18th meeting decision was priced in at 60% certainty, that was the moment where I said, fade it. And we're now at 30% for 50. I think that that's the recurring theme, that unless and until the bottom falls out, the market continues to misprice the Fed, and that continues to provide us as traders who are nimble opportunities to fade SOFR or 2-year notes or otherwise when it gets out of whack. But I don't see central banks going too aggressive because the sad reality is they're like a pendulum and they swing in two directions. One is of forming bubbles and one is of sort of breaking bubbles, popping them, right? One is of adding liquidity to the system in excess of what it needs, and the other is removing it in excess of what it needs. So I think we're still more likely to stumble into that other side of the pendulum, or unfortunately something probably does break, and then that's when they respond in size.
I was actually going to ask you what you meant by sweeping it under the rug. So is that like a foreign central bank sees that their banking system, so like let's just use Chinese banks or Japanese banks, they see that the dollar that their Japanese banks or Chinese banks have losses on U.S. Treasury bonds or U.S. commercial real estate, and so they panic. They go into yield curve control. They go into debt monetization. They start buying bad assets from their banks, and then they go into some type of bailout mode.
Yeah, exactly. I mean, that's the sort of thing that I would expect as a reflexive response from, for example, potentially China, where we know they have a lot of bad real estate debt and they're trying to ring fence it to try to sort of minimize the global impact and especially the domestic impact. But at the same time, they can't stimulate in excess of what they probably would need to do, or even stimulate to the threshold that they need to do, because the offshore rates of their currency would be appreciably dropped. They would see a significant markdown in exchange rates. And so I think that you do see this potential of this sort of slow, methodical push to try to sweep some of this stuff under the rug. Like you said, buying some bad assets, trying to encourage banks to prop up their balance sheets by any means necessary. And I don't know that that's necessarily going to bring about anything but a very slow recovery. Because what we see in every situation where this happens, whether it's Japan coming out of its real estate crisis, the US coming out of the great financial crisis, what China is dealing with now, European Union over the last 30 plus years, it's substandard economic growth. The more problems you sweep under the rug, the more structural issues that exist that aren't addressed, the slower the growth becomes and the more expensive it becomes as well. And unfortunately, that's kind of what this really long-term era of zero and negative interest rate policy, and that's what brings up, kind of the outcome that we're looking at in the future, which is one of potentially slower growth, but also on the other side of it, upside inflation risks, because we haven't in any way resolved the structural inelasticity of the supply side. There's still a lack of supply in many key areas. And even though we'll have ephemeral issues, where there'll be an overabundance of supply in, say, oil or maybe labor or otherwise, in a normalized, growing global economy, there is still a significant deficit in energy, in arable land, in clean water, in labor forces, in a lot of these countries that have large aging populations, in industrial metals and otherwise. We haven't resolved any of that. And it would take 5 or 10 years, as we've discussed during prior interviews, to resolve these things. And so I think on the other side of this, when the pendulum swings into growth mode, if we do get into full growth cycle mode again over the next year or two, the other problem for central bankers is going to be, well, on the one hand, we've got all these folks that have assets that are underwater, but on the other hand, we have this, mandate to try to subdue inflation, and it's starting to come back much earlier in the cycle than we suspected. And I think that's the concern, especially if, like you said, there's this large fiscal impulse that comes online with the next administration, because that's going to pull forward that scenario and that demand.
Well, it's not just the US. It sounds like you're describing global currency weakness, that these other countries, the governments and central banks, do not want to cut government spending. If there's any problems with their private sector banking system, they'll just do bailouts, or the central bank or the government will buy up the toxic assets, or they'll do some type of accounting gimmickry. This sounds like global currency weakness across the board, that there's not going to be a lot of strong currencies, especially if the Fed goes into a serious rate cutting cycle, because the dollar has been relatively strong since the Fed started raising interest rates versus other currencies. And it also sounds like you basically named a very good argument for gold in a lot of different currencies in a bull market as a core position. If these other currencies are going to be weak, these governments are going to tax and debase the currency, that the gold price in Japanese yen, Asian currencies, euro, Canadian dollars, even US dollars is going to be in a long-term bull market then.
100%. My thought on gold had been 2,600 by September. We're almost there. This was a thought from like 5-6 months ago, and then $3,000 gold in the first half of 2025. And I stand by that. I still think it's quite likely we could hit 2,600 quite soon. We were only 30-40 bucks away from it recently, and 3,000 the first half of next year seems like a no-brainer with everything coming online. And currency debasement, unfortunately, is the name of the game. All these currencies over time we're seeing growth in money supply. When there's more money and there's kind of more units of credit or paper currency available, that's a technical debasement, and that's very bullish for precious metals. And the other side of it is silver could also have a really robust set of demand if we see the economic cycle improve, and we see a lot more investment in communication systems and renewables, in military technology and the replenishment of our arsenal and everything else, as well as that new Samsung battery tech that's been talked about that could be rather silver intensive. So I am still very much a gold bull here. I think it is the ultimate hedge against uncertainty, and we live in very uncertain times. And I'm increasingly looking at silver, if we can get above that 30-50 level on a weekly closing basis, as being another long swing trade opportunity, particularly if industrial demand starts to come back.
Yeah, I think there's a pretty high probability we see gold at $3,000 in 18 months or less. I mean, it depends on the macro condition. Maybe we see a temporary correction down to 2,100 or 2,000, but I think that would be a buying opportunity. Although if you look at the physical demand, I mean, I just read a blog article from David Jensen, and I don't know if you know who he is. He's a lawyer who looks at like LBMA filings and stuff like that. And it looks like a lot of Asian investors, we're talking like not just retail, we're talking like institutional investors, pension funds, are starting to take delivery of these large amounts of contracts on the physical exchanges. That never occurred in the past. So there's like enormous physical demand, and that's what's caused the big move really since October 2023. The Asian retail demand, a lot of entities, not just central banks, have really increased the demand for gold coins and bars and jewelry. We haven't seen this level of Asian retail demand probably ever.
And it's interesting because we have yet to get into an area of euphoria in the US, which typically marks interim tops in gold. And usually you see it in the form of enormous amounts of ETF unit creation because folks are buying, say, GLD or IAU or, other ones like it. And then on the other side of it, you typically see huge amounts of call buying by retail as well. We've seen neither. In fact, GLD unit creation has been on a downside trajectory. It's been shrinking. There's been selling of GLD, and call buying has been, de minimis. So it suggests that, in terms of sentiment in this space, it's still subdued. And gold as an allocation for institutions in the US and for retail investors in the US is still a very, very, very small part of their portfolio if it exists at all. So there's a lot of room for that to expand, especially if uncertainty continues to increase. And one thing that's very interesting about gold is during a period of time of economic slowing, gold tends to benefit quite a bit. And there will be periods of time, for example, if the US gets into a recession, where gold and the dollar can rise side by side. It's not rare. It's not extraordinary. It happens quite often in recessionary periods. And that's the sort of outcome I would expect, that we could have a scenario where both gold and the dollar, which I believe bottomed recently around 160 cents, I think that there's room for them both to rally. And I think that's going to be something that catches a lot of folks off guard. But that also tells you that in other currencies, gold could perform even better.
You're a wealth of information, Mayhem. I want to thank you so much for your time today. If my listeners want to check out Macro Advisor or TraderAid, how do they do so?
Sure. Thank you so much for your feedback, Jason. I love being on the show with you. It's always an extraordinary and fun conversation. We cover so much. So if you want to learn more about my work, you can visit traderaid.com. In fact, we've got a 3-day trial on our Discord right now, so you can check us out, no obligation. I also build tools like options visualizer tools that you can plug into frameworks like Bookmap. You can find out more about us on our website at traderaid.com. You can also visit us at macrovisor.com, where we help investors learn more about how to take advantage of broad macro trends. We both do institutional consulting, and we have a newsletter there. You visit us at macrovisor.com. You can sign up for our free newsletter. And then if you want to go into some of our paid premium products, we have a monthly subscription for retail available for about $35 a month. And then consider following me on social media, where you can find me at Mayhem 4 Markets. That's Mayhem number 4 Markets on YouTube and Twitter. And I've just opened up a Twitch account for the occasional streaming I do there as well. And then finally, you can look at my link tree. It's linktr.ee/mayhem number 4 markets. That's Mayhem 4 Markets. And Jason, it's always a pleasure being on with you. I appreciate being a guest on your show. I have a great deal of respect for the depth and breadth of content that you cover and the amazing guests that you bring on. So I'm humbled and honored to be a part of Wall Street for Main Street.